Alrighty, it is that time for Money and Motivation with Nancy Fleming.
Good afternoon, Joe. How are you this evening?
Good. Looking forward to another great big storm tonight, I think.
Another one?
That's what I heard.
Didn't get damaged enough with the last one, right?
Oh, yeah, nice.
Gonna come beat you up one more time. What were you saying? The concrete is still wet on your wall repair?
Yes, I just had it all dug out and made sure it was a couple 3 feet deep this time. But it's not dry yet, so...
Well, you guys know how to do it out here.
We'll see.
It's nice you take the brunt before it gets in town where I am.
Yeah, there you go.
That's right.
Save you a little.
I stayed inside. I miss these great things. I must have some kind of animal instinct or something because when the storms come, I tend to sense it and go inside. I've missed both of the haboobs, and I was inside all day Sunday when that storm hit.
It's a good thing you missed the haboobs. My dog got valley fever during that one, and they're all full of lots of toxic things.
Oh, and I'm so sorry to hear that. That can be pretty serious.
Oh, yeah.
Well, before we have a special guest, Kevin Boudreau. He is a certified public accountant. Kind of like I am in the financial field. I'm a certified financial planner. So we're going to talk about the surprises that we're going to have next year. But first, for our money moment, I thought, Joe, I would ask you, what do you think you have in common with millionaires?
I've got phenomenal style.
That is a great answer. What I actually was going to say is, interestingly enough, people who become millionaires, instead of being the great wheeler dealers we often think of, they often are just really steady people. So most millionaires have never been divorced.
I have that in common.
You have that in common with
And what about yard sales? I do a little millionaire yard sailing once in a while.
You know, that's a really good point because we'll talk about that in a second. We've got the fact that they are frugal, and so you would think that a millionaire would live in a millionaire style house, right?
Right.
Well, believe it or not, 3 times as many millionaires live in houses worth less than $300,000 than those who live in homes worth more than $1 million. So maybe we have the wannabes out there, and we'll let Kevin talk a little bit about the tax ramifications of that because there's a reason. And another thing is that they do look for sales like you have talked about, but in addition to just not moving a lot, they tend to stay in the same house. So most millionaires have been in their same home more than 20 years. There's a good tax reason for that, is there not, Kevin?
Well, I think it's more of a cash thing.
Which is tax, right?
It is, yeah. But I don't like moving. I don't like having to pay movers to push stuff in and out.
To break your stuff.
Exactly.
Right.
Exactly.
Right. And they also tend to hold their stocks longer, so we don't see a lot of day traders there either, which is, again, short-term gains also. And then the deal, yes, they tend to stay, the majority of people answering the survey tend not to go into stores too much. And I have a saying that you've heard me say before is I have a real problem with stores because we have different goals. Stores tend to want to part me from my money. Now, if I'm in a toy store with my cute little granddaughter, they succeed really well. So we find that people who want to have money hold on to it, and they tend to stay away from stores, and they tend to look for bargains. And we've had fun talking about the yard sales. And we talk about yard sales because do you really think you get the best deals on eBay?
Sometimes.
Sometimes, but because everybody is seeing it, you've got demand coming into play, so you don't often see the best deals on eBay. But we can often have really good ways to look at yard sales. Now, Kevin, if I go buy something at a yard sale or sell something at a yard sale, is there any taxable consequence there?
Fortunately, no.
Fortunately, no.
Because the thing is, where most people would want to go is you've probably, if you've sold something, if you're the seller, you paid more for it than what you're selling it for.
True.
So you're going to have a loss. So, can I take that loss and reduce my taxes? No, that's not the business you're in. Mm-hmm. But then if you're just the purchaser, then no, you don't have to worry about sales tax. You don't have to worry about income tax or anything like that. So,
now, what about people? Because sometimes what people do is they go and they will try to find something on sale at one, a really good deal at one yard sale, and then they'll have their own and make a profit that way. That came up on a previous show. Somebody was doing that to bring in extra money.
So you're a wholesaler.
No, well, you're buying stuff from your neighbor's yard sale to sell it at your own, or the yard sale across town or something. So how does that work?
I mean, it's really no different than what I said before, because it's a case of you purchase something, and even if you do make a profit, technically you would have to, black and white, perfect, pristine tax return, yes, you would report it. But, then you get to deduct your gasoline and driving around. You don't get to deduct your time, but you're not going to have a profit on that.
Right. So for all intents and purposes,
it's all yours.
We're good, yeah. So there's a few tips for yard sales, and I knew that Joe would really be interested in this. For example, those of us who are past, do we have a question on the call, Joe?
No, we had an interesting comment, though. Let's see. We have Rod says, I'm a self-made millionaire, and I live on my sailboat for more than 20 years now. I have no physical address and love the freedom. And now I'm listening from the Bahamas.
Oh, that is perfect. In fact,
that is cool.
That is. One of the things I like about, and frankly, most people who become successful retirees work with someone. The number is just, and I'm sure you've seen this in your practice too, we need to work with good accountants, we need to work with good planners, because we want to take some of the emotion out of it, and there's stuff about money that is so emotional. And if we want a good retirement, it's just the numbers are just out there. So not necessarily that he necessarily did work with someone, but we're finding that the frugality and the planning, because a lot of people who become millionaires didn't inherit it. Most millionaires, I think there's only 14% who inherited it. The rest worked very hard.
I'm guessing Rod was probably planning how long his yacht was.
I'm sure.
Probably.
Yes. Well, and a lot of times, people, rather than doing a yacht, although I did have one client who did that. Being in Arizona, I don't get too many full-time boaters, but I do get full-time RVers or part-time RVers. And so same kind of thing. The planning and the savings is really, really important. And so you look for bargains in order to be able to have that real nice RV or yacht or whatever it is that you're looking for.
What happens when you have no physical address?
You pay no taxes.
Is that true?
There's probably, because the thing is, where's the government going to come get you?
Wow.
Tongue in cheek, I'm saying this.
That's incredible.
But that's one of the Warren Buffett measures right now is there's talk of these ultra rich. So it's none of us sitting in here today, I'm assuming. They're renouncing their citizenship, and so they're paying no taxes.
I've read some articles on that,
and that's
you
okay.
Wonder,
yeah,
and
sure.
you wonder, and there's been a lot of controversy, because if a person's become ultra rich here, then they go renounce their citizenship. Where is the loyalty to the institution, the country, the people who made you ultra rich? But that hasn't seemed to matter, because they still renounce their citizenship after they have all the money, and then they don't have to pay the taxes. So yeah, I have seen that, which just means they've got to make some better changes in our tax laws than what we have going on right now.
I think everybody can come up with that conclusion, and there's differing ways to do it, but we don't have enough time tonight to get into all of that.
Well, no, but we'll get into a few of them. There's a few
Sure.
hot buttons, I think, out there. I know we've talked a little bit before the show, some of the things that are really, really stressing us out, and I think it's going to make more and more people, while we don't renounce our citizenship, do things where we can do things like yard sales or whatever else we come up with that we can do. One of the things that on this tax, though, that really has me disturbed, because I feel like next year, things being as they are today, people are going to be really unpleasantly surprised next year. And so why don't you go ahead and elaborate one of the tax changes that's happening
the thing
in
that
2013?
Sure. Nancy, I think there's two things that, and the first one has to do with your medical deductions, where I think we're used to going to the doctor, we have our copay, we have our prescriptions and our eyeglass expenses.
Dentist, don't forget dentist.
Dentist, absolutely.
Hearing aids.
Well, yes, we've got, I think, two kids.
But not cosmetic surgery, right?
Not cosmetic surgery.
No. Okay.
That's considered
Some
personal.
people figure that that's very necessary.
Well,
out there.
If you're a cosmetic surgeon, you're going to take me down, or I'm going to take you down a different road just for a second. Under some of the proposed legislation, I think that the plastic surgeons are going to become the rich people.
How is that?
Because the government is going to limit, under the proposals that seem to be out there, what a general practitioner or your primary care physician is making. And
they're going to put a limit on what a doctor is making?
Exactly.
They cost so much money and time.
Because
What's going to motivate anybody to go to medical school and give up 10 years of their life if there's going to be a cap on their earnings? That just
We're all
does
gonna
not
die.
seem right. We're all going to die.
Apparently.
they're going to go into plastic surgery, make everybody look beautiful.
Wow, that's
So,
incredible.
so-
Just unhealthy and beautiful.
So can they be a general practitioner for half their practice and then do another type of practice that doesn't cap? Why would they cap a general practitioner, not cap
Because you're
class?
providing health care services for everybody.
So isn't that a good thing?
It is if you're the consumer.
Okay, so where? So
I'm going to get
I'm
myself in a
missing.
pickle here.
I'm really missing the point here.
It's on the earning side from the doctor where I'm seeing some issues because I believe that folks who are in the primary care areas will not see any potential to grow their income, to really expand their practices because they are going to be regulated and capped as to how much they're going to get paid. They're not going to have a lot of private pay is what it boils down to.
And so they're not going to have an incentive to take extra patients, and so we're going to have not so much a shortage of practitioners, but they're just a shortage of care because the practitioners aren't going to take everybody that might need help.
That is absolutely one of the economic theories that's out there. Absolutely.
That's a very frightening thought. So does that mean we're going to see a rise in naturopath or alternative medicines, perhaps? Because the naturopaths are so far not capped. Are they part of this?
That I don't know.
We don't know about naturopaths. I haven't seen them mentioned, but if anybody knows about naturopaths,
So anyway,
that'd be great.
I've taken us down
No, that's a very
diversion
important
here.
path, though. I mean, there's so many. That's what I'm saying. We have the main points, and then we have these fine little
Johns. Yeah.
yes, that we may not think of.
Interestingly enough, that was a doctor, Dr.
Good.
Miller out of Scottsdale.
Thank you, Dr. Miller.
And he said, it's breaking us. Doctors are now quitting, which has been unheard of. I know personally 17 doctors that are in other trades, and I'm working on a startup business right now myself so I can get out of it.
Sure.
That's awful.
And the
That's
sad
where
thing is my
Wow.
guess would be, because I also have a neighbor who did a surgery on my mother, and he was saying that he doesn't know who will take care of him because I'm guessing that Dr. Miller, along with others, is an experienced doctor. So he's already gone
sure,
through,
yeah.
he's down the road, it's not what it used to be, and so we're losing our qualified, experienced, expert healthcare professionals to government oppression. Is that a good way to
He
put
said
it?
we're going broke,
We're
literally.
going broke, yeah. And that's just not right. We need our doctors. And so I don't know how we as citizens can, I don't know.
Well, I got an
lobby our
idea.
legislators. What?
That's
I've got an idea to help the doctors and
Good.
also to help the consumers like you
Because
and
it's a
I.
really scary thought to me. I'm not getting any younger. I mean,
Yeah.
you know what I'm saying?
2012 is probably going to be the year to dogpile your medical expenses because right now, if you can itemize on your little Schedule A, the first 7.5% of your adjusted gross income is considered personal, and you cannot deduct that. That floor is going to go up to 10%. So what that means is that if there's a household that makes $50,000, right now that would mean that the first $3,700 some dollars of medical expenses are personal. You can't deduct it. Anything over that you can deduct. In 2013, that's going to go up to $5,000.
And is this under the Patient Protection and Affordability Health Care Act?
That would be
Now,
correct.
in your
Yes.
professional opinion, does increasing the threshold from 7.5% to 10% make health care for the patient more affordable, and does it make the patient more protected?
No.
No, it does not. Okay. Point number one, why the Supreme Court called this a tax bill, because if we're raising our taxes on our health care, it's got to be a tax bill. So this is where it comes in. So when you say dogpile, that means anything we can think of that we can do this year in order to get the deduction. So if you need new eyeglasses, right, that comes under it.
Go get your physicals. If you need the new eyeglasses, you need the contacts on top of that. You go get your teeth whitening. You go get your...
Now, anything with a dentist counts, right? There's no prohibition there like there's for plastic surgery.
There's probably some things, I just don't know them off the top
Okay.
of my head, that would
But
be
generally
considered
speaking.
cosmetic. Right, to be able to do that.
Like the veneers, maybe some put veneers on the front of their teeth that
Yeah,
might not be deductible.
But, if you got the luxury to maybe enter into orthodonture, then yes, you can do that, and that is covered.
Oh, okay.
for
So it
that. So
just
you could,
depends.
I could straighten out my teeth a little bit. And,
Okay, so anything we can afford to do this year so that we can get the deduction this year, we're going to want to do that because it's going up to 10% of everything up to 10% of our adjusted gross income is not
the
on our
first
schedule. Like
10%.
starting in 2013, right now it's 7.5. Now, is that also going to apply to people who have long-term care premiums? Because right now those are listed on Schedule A. So is that lumped into?
That is still part of the calculation to get up to your 7.5% today, 10% tomorrow.
All righty. So in effect, for those people who do itemize that have long-term care insurance, we just raise that too.
That is correct.
Okay. All righty. And so what other little surprises are we seeing happening in 2013?
I think the ugliest one for those that have been prudent with their money and they've invested it, they're probably earning interest and dividends.
Well, doesn't a lot of what we see going, aren't most tax bills designed to hurt people who've been prudent and invested and have saved? So we've got the kind of the ant theory going here.
It certainly feels that
It
way.
feels that way to a lot of people that I work with, I talk to, and
You know, the other
struggle
thing
with,
is just the common, I'm an employee of someone else, and so I get a W-2 and I get none of these deductions that all these infamous small business owners get to be able to take, or the people who create the rental properties where they can take.
But do you know statistically how long a small business owner works as opposed to an employee? I mean, is there any numbers out there? Because I know I often get there before my employees, and I'm often there after they leave.
My mantra,
and that seems to be that the
my mantra has always been, the small business or the self-employed person only works a half day. Now, whether it's your first 12 hours or your last 12 hours, it doesn't matter.
You scared me there for a minute.
Yeah, no, that is.
I'm like, what's going on with me?
That is so true. In fact, I've heard people say that there's a new that the real working class is the small business owner.
I think that's absolutely true, and that's who's driving the economy, because they're providing the employment for one or two people.
Right.
It's not the Microsofts of the world and the Intels, and God bless those companies,
Right.
because they're wonderful and they provide great benefits, so that hopefully they have these wonderful healthcare plans and insurance plans to cover everything that's sitting out there.
So what's this scary tax that's coming out that's going to affect people, now we already know that we've had a war going on, the savers, and this war that's going on with the savers is that we've got the low interest rates and they just can't get a return. So it's especially affecting retirees, because all retirements has been built pretty much on a 4% return, and we're not getting that on CDs and in other areas often. Not all the time, but often. And so how do they pull money out to live on? And often we see the retiree having to live on principal. It's been one of the challenges of people coming in to visit with me. We have this problem, and we work out the solution, of course, but it still is a huge, huge problem. So is there more than that going on?
The driver that may really hurt them is the fact that Medicare is going to start tapping into some of the earnings of the people who have interest in dividends, something called passive income.
Passive income.
So that's where I used, Intel a little bit earlier. Intel pays a dividend. So if I own 100 shares of Intel and I get, I don't know what the dividend is, but let's say I get $2 a year for every share, then of that $2 for every share that I own, I'm going to be subject, and the literature is not complete yet, but
another one of those scary taxes that we just have to pass it and read it later, huh?
Yeah, exactly. And we're going to be paying 3.8% towards Medicare on that, where I've never done that before.
Okay, so for every $100 of passive income, we'll go through what some of passive income is, it's going to be $3.85.
80, yeah.
Okay, so
$3. Let's just say $4.
Okay, so roughly $4, just less than $4 of every $100 of passive income. Now, first of all, isn't this just going to be on the people earning more than $200,000 a year?
There's differing literature out there with respect to that. That is one of the things that I have also read where it may flow through to everyone.
It could be everyone. It could be, because we're seeing some taxes now that are not going to be income taxes outside of income taxes is what we're starting to see, fees.
Yes.
So what that means, if we look at a worst case scenario, because in planning, we plan for the worst and we hope for the best. But if we plan for the worst and it doesn't happen, then that's okay. We haven't hurt ourselves. But if we don't sit sit down and plan for the worst, and the worst happens. In this example, we're saying, okay, we have a tax that's starting that we maybe haven't budgeted for. Who budgets a lot for taxes anyway? We don't. We do our withholding kind of thing. So what we're saying is passive income. So you talked about dividends from stock. So we're dealing with, you buy Intel or you buy Verizon or whatever stock you buy, you get in your dividend, and we've had, now haven't we had, well, we'll get to the qualified dividends first. We're going to talk about the Medicare tax for a minute. So we're paying an additional $3.85, just shy of $4 tax on our passive income, which is dividends. What about interest on our CDs?
Same.
So now we're going to pay this. So we're paying, regardless of income. Well, right now we don't know, but if in a worst case scenario, regardless of our income, we're still paying this Medicare. What about a retiree that's already paying a Medicare premium?
That is considered health insurance. So it's not part of the tax.
All right. So hear this, Medicare people. You're paying your Medicare premiums out of your Social Security. There's going to be an additional Medicare tax off of all CD interest. What about annuity interest?
Annuity interest would be the same character.
Okay, so
I'm sorry for going CPA on you here, but
I'm going to just go through each one because I want to say each one so that everybody out there knows what we mean. We say passive income. I don't have somebody thinking, well, what about? So I'm going to try to think of most of them. So we've got the CD interest, annuity interest.
Yep.
What about money that comes out from IRA accounts or retirement accounts? Is that counting also?
That is up for discussion.
Okay, so we're not sure about that one yet.
From what I've seen so far. However, the advocacy points that I've been reading in my financial literature and tax literature is that we may want to consider taking more of some of our retirement income, like from an IRA, in 2012. So we've hedged or protected ourselves from 2013 because we don't really know. And if Congress behaves like it did 2 years ago, where it passed the tax bill in the 50th week of the year, I mean, that just drove me nuts.
It drove everybody nuts. I know they even extended the deadline. So right now, I'm sticking with the Medicare tax. We'll get to remind me to get back to that point in a minute. But I got to stay one at a time because otherwise we're going to go down one of these little lanes again. So our passive income for our Medicare tax, we do not know if it's going to include our IRA distributions.
Correct.
Okay. What about if we're going to take rental income? Rental
income your net income from that is passive. However, there was literally a Journal of Accountancy article that came out this morning talking about a false internet rumor that's out there regarding what they're calling a real estate transaction tax.
I read about that. In fact,
false.
It's all over the place.
It's false. Is the fast answer. So there were people that were thinking if you have any type of transactions in the real estate arena, that it would be subject to this 3.8% tax.
Right. It was all over the place. I found it in fact, we had a speaker on. We found it in 4 different areas where it was documented.
Yeah, the basis for I'm reading from a Journal of Accountancy article here. The basis of the rumors is the new 3.8% Medicare tax on unearned income, which will take effect next year. It has kernels of truth, where there will be a small number of taxpayers that have to pay a surtax on the gain of sale from when they have these real estate transactions, because it's passive. So, and to try to drive back to this for a second, if I'm earning as a self-employed person, if I'm an employee for a company that's earned income, I do work and I get paid for that, versus I've invested in something. Okay,
so let's revisit this then. So there's 2 sides of the real estate: the rental income. So you own a second house and you're renting it out, or I or anybody out there's going to have a real estate show before us. Will the gain, the profit, in other words, on that income, will that be subject to it? Right. And then the second, what about, so I'm confused right now from what you just read to me about how that's going to work on the sale of property. So let's take one of this. Do the rental first and the sale second.
Sure. So we'll do the current year income that we have. So I rent out and I earn $10,000 on my rental property for the year. I have expenses because, let's say I'm fortunate, I've got no mortgage on that house, and I actually, after depreciation, have $1,000 net income. Then that $1,000 would be subject to the 3.8% Medicare tax.
Okay, so in addition to normal income taxes, we're going to have an additional surtax of the less than 4%. What about now? Let's go back to the sale of property again, because since it's all over the place and there's lots of reliable sources that are talking about this tax, what is your Journal of Accountancy saying? We'll throw that in the mix too. It seems pretty confused.
It is saying that would be treated much the same way because it's from a passive perspective. I've invested in this rental property, so I've stuck $250,000 into a rental house. I get down the road and sell it for $300,000. Then that $50,000 gain that I would have on it is subject to the Medicare tax as well. So that's where you make sure that you have good accounting records, and you find ways to be able to say, oh, I paid $250 for it initially, but you know what? I improved this. We just had the home warranty lady who was here a little bit ago. Oh, because of that, I upgraded the air conditioning unit. Well, that went into the cost now for my $250,000. So you want to whittle away at which the cost or your basis is.
And what about a personal residence? Because as I was researching this, I also found reliable sources that talked about this tax, and it seems like it's very confusing to many, many sources out there.
Yeah, the statement
here.
What
about your own home?
A very small number of taxpayers will pay a surtax on the gain from the sale of a principal residence.
Okay, so that is a possibility.
That is a possibility.
All right, so we really won't know until it's actually there.
Right. Okay. And I think it's going to feel, much like the first thing that went through. It's like, oh, let's get it through. Now we'll read it and see what we really said we're going to do.
It makes it, when we don't know the rules of the game, it makes it really hard to play. And so my big thing to my people is, and I've said it over, and anybody that's my client out there is going to know how much I've said, please, let's tax plan prior to 2013, because otherwise you could be in for some really terrible surprises. How about the dividends from a bond? So instead of owning a company stock, I own that company's bond. Right. How's that going to work?
That's going to be treated like interest. So,
the same, it's still passive.
Right. So I've got my Salt River Project Improvement District bonds. I've got my City of Scottsdale, revenue bonds.
Yeah, so how about muni bonds?
Municipal bonds will be treated the same way.
Okay, so the muni bonds are going to stay federal income tax free, but we're going to take that away and put this, what's called a Medicare surcharge tax on that also.
You said it beautifully, because it's income tax free.
Right. So what we're doing is we now have a tax code that minces words. I mean, to me as a consumer, if the government takes my money off of my income, it's an income tax. I'm sure there are people out there who say if the government is taking money off my income, it doesn't matter what the name of it is, it's an income tax. But I mean, that's just me. I'm a regular person. Money being taken away from me is a tax.
A tax is a tax.
Yeah. And they're taking it on the fact they give it a different name doesn't make it any more pleasant.
Yes.
They're still taking it. So we've got any type of bond, whether it's a corporate bond or whether it's a muni bond. And the muni bond, I think, is going to be surprising for people, because we've got a lot of people out there who take muni bonds to avoid tax, and now all of a sudden here's a tax on every $100,000 of income that has never been there before.
Oh, right, because I can maybe go find a triple B plus bond, so I can get a high yield, but I want it to be investment grade.
Right.
And I can earn, let's say 4%, 3 or 4% on that. Or I can take a municipal bond, and I want to be a good soldier and say, I know that the town of Queen Creek is issuing bonds. I live in Queen Creek, so I want to support that. I'm willing to only take a 2%.
Right, or the town of Mesa, yes, or any of our towns, right. How about, is that going to do then with funds? Is the same thing when the funds are going to distribute, or mutual funds are going to distribute dividends, and they're going to distribute gains. So how does that 3.85 work on the difference, any difference in the dividends or the gains that they distribute?
I have not heard that delineation, and I mean that's a great point.
They haven't gone into that much detail, because considering we don't even understand the house tax yet, to expect that much detail, I suppose that's going to make your job real interesting when it comes time to figure all this out.
You buy good tax software as part of the issue too.
If it's figured out, we remember what happened. So we're not sure. They haven't gone down and specifically said, but if everything else is, we can pretty much throw then the dividends from the funds. Now, capital gains on the sale of stock, that's also subject to the Medicare tax.
But and I think that's probably the same answer as the
I'm saying is capital gains also subject to the Medicare tax?
That one I have not read, which is why I gave you kind of the same answer.
Because the gain on the housing,
right,
but not the gain. So we don't know. That's
I haven't read it.
Okay.
So it may be out there, and I just haven't had enough time to finger through all this stuff yet.
I can't imagine why. You got to do your day job too, right? And then still try to figure all of this out. All right, so we've got this big tax that's coming. Now, how about in the area where we've been able to take qualified dividends? Let's visit that from what's happening next year, and first explain what qualified, non-qualified dividends are, and then how will that change next year?
The qualified dividends have to do with the nature of the investment. I'm trying to think of simple layman's terms to be able to pull that out. But the qualified dividends are subject under the tax cuts that the Bush administration had implemented, and they are taxed at a lower rate. So think of it from the perspective of qualified means you qualify for a special tax treatment. Mm-hmm. Those special tax treatments are scheduled to expire at the end of 2012. So what that would mean is that if my marginal tax bracket is 25% and I have qualified dividends, I today and for the last few years have only paid 15% on those qualified dividends. The non-qualified dividends, I paid whatever my marginal or my incremental rate is, so let's say the 25%.
So they take the highest marginal.
Exactly.
Right, so it works out well because if you have 25% gain on your interest income, but only 15% on your dividend income, and then 0 on your muni bond, you can see where people were really benefiting by figuring out ways to take income on a tax advantage basis.
Exactly,
right?
Yeah, because you want to keep more money in your pocket.
Don't we, though? I would agree. We're going to go back to the yard sales, right?
Yeah, we'll be having the yard sales to make up for that 4%, the 3.8% tax that's there. But I think that what we're going to run into is with the expiration of that, there's going to be less incentive for people to invest. And so let me take and toss out to you as the financial planner, and I know that neither of us have this wonderful crystal ball to know what's going to go on. But if I don't suddenly have the advantage of the lower tax rate and I'm being taxed with this extra surcharge, am I going to continue to invest in certain market investments?
Tax planning is a real essential part of financial planning. And because we need to be able to keep money, and if any money that we don't keep, regardless of where it's going, means that's how much more we have to earn. So if we have a higher tax bracket, we have to earn more money, some way earn it or have it come to us passively from monies we previously earned and invested in order to maintain our lifestyle. Uh-huh. And I know maybe that's why the guy's out there on the yacht in the Bahamas, soaking up some rays out there, I'm sure. But it is very, very, very serious because, we've got this hand that keeps trying to go further and further into our wallet, and we're trying to slap it and say, don't you go into my wallet. I did earn this. I did save this. I paid you going along. You can't come back and keep profiting off the fruits of my labor and my savings and so forth.
So here's my nugget that I think might work. Those people that have the fortune and the benefit of having some type of retirement plan, and let's just use an IRA, you might want to seriously consider converting that into the Roth IRA, which means that I would take and pay taxes on that, and just for the benefit of anybody who doesn't know the difference between the traditional IRA or the Roth IRA, the traditional, you have not paid any income taxes on that. In fact, you've lowered your tax bill, and so it's in a deferred plan. The Roth IRA is an after-tax, now protected qualified retirement plan. So that means I pay taxes on the Roth today, and then any increases, be it through dividends, interest, appreciation, capital gains, etc., I don't have to pay any more taxes on that. The Roth IRA seems to be awfully attractive, and I've not seen that mentioned as being part of the 3.8% Medicare tax.
Oh, no, that is very interesting because, and so let's revisit this a little bit more. For example, if you've, I often use the 15%, $70,000 for married people in my example. So let's suppose we take $50,000 of income, and you can have up to $70,000 and still pay 15% in taxes. So what we would do is we would say, okay, let's take $15,000 from our qualified account. So it would either be an IRA, it might be a 401k, and jump through the hoops for that. And we will then have that be a Roth IRA instead. In 2013, you're going to pay the 15% tax on this money that you move over to the Roth. However, when the money comes out, you have to hold it for 5 years before you can pull earnings out, or they'll be taxed. You can pull your principal any time that you've already paid tax on. But after that time, you're not forced to withdrawals. And according to what we're now learning, it's not mentioned anywhere for the 3.85% Medicare tax. And I think there'd be a real uproar if we did, because many, many people have moved from IRAs to Roths, willingly paying more taxes. And I think that being true to that, that's part of the reason it's not there. So no income taxes and no extra fancy name taxes, whatever they call it. So that's really a good thing to do. Going forward, since we don't know the tax brackets, this year, doing as much of this as possible is something I've really been working with, I know, with my clients on. And we look at the tax returns, and with some of this news going forward, there may be people out there who want to consider even bumping up into the next bracket, if need be, in order to avoid what's going forward.
Yeah, the only bracket that I really think that it makes sense for people to potentially jump into, since you bring that up, is maybe moving from the 25 to the 28% tax bracket the way we're at right now. Because if you're in the 15, to jump up to the 25 gets awfully pricey.
It does, right.
To go from the 28 up to the 33 or 35, I'm just thinking, wait a minute, I'm willingly giving Uncle Sam 33%, or this year it could be as high as 39% of my income, and then the Arizona Department of Revenue takes another little portion of that as well.
Right.
But especially those the tax savvy consumers that are out there, they can take and push up, and the smart ones have over the years. They're taking and looking at they're doing a pro forma tax return in December and saying, okay, I'm sitting here on December 15th. I think I've got, as you just explained, I think I've got a $20,000 threshold where I can push something in, call up your broker, your financial advisor, and say, I want to move $15,000 in. I want to move. You could push. I mean, if you just barely trip over into the next bracket. That's
right. So if you're whether you're in the 15 or if you're in the 25, you just want to push up against
to that maximum,
just to the maximum in that particular bracket, so that it's not too painful, but you're maximizing the bracket that you're in, because at some point tax will be paid on that money, and if you pay tax moving forward on the money, it could be higher. And we're not making enough really anymore to offset the higher tax. I mean, regardless of where we have it. I gave my little millionaire example. A lot of millionaires aren't doing super highly risky things, and so if we're not doing super high risky things, we're generally going to have a more stable return. And even if we're making nothing, of course, in CDs and instruments like that. So there's not a real incentive to say, all right, let me pay tax on this money at a future time because my earnings will offset the taxes. We can't necessarily say that in the way the economy is today.
And then you've got inflation.
Yes. We will throw that in the mix also. So it's going to cost us more to live. So they talk about this fiscal cliff coming up, and that's really where these taxes are going up, and in more ways than I think people are aware. We have some government programs stopping that are putting money into the economy, but nobody ever throws inflation into the mix. And so if we throw inflation into the mix, it's really churns everything up.
Exactly. And so I think, getting back to the line of business that you're in with doing the planning and having, planning for the worst, how can we take and do that to be able to have a quality of life where, we've worked so hard for so many years. Now I want to take and enjoy it. I want to take and, be able, as you were mentioning, to go shopping with your grandchild and to be able to spoil them and be a grandma and do those types of things.
And it really, isn't that fun?
Exactly.
You can go there and these just 3 years old, and what did we see? Toys R Us had this big sale, and we found a Rapunzel placemat for all of $1, and she was thrilled. Now, that's not going to be that way down the road, so enjoy it while we can. I notice it's time for us to take our commercial break, so we'll stop for a few minutes and then come back and talk a little bit more.
Are you experiencing computer problems? Is your computer running slow, bogged down with viruses and spyware? You need a reliable and knowledgeable, trustworthy computer service company. Contact Computers, Networks, and More, located in Santan Valley. Get your computer or laptop running in top condition by a certified technician with 20-plus years experience and beta tester from Microsoft. Computers, Networks, and More provides repairs and solutions to any computer-related issue, whether it's software, installation, troubleshooting, updates, or tune-ups. You can trust Computers, Networks, and More. Contact Jeff Monday through Saturday, 8 a.m. to 7 p.m. to schedule an appointment. We can have you up and running quickly, usually within 48 hours. Located in Santan Valley. Computers, Networks, and More. We're here for you. Contact Jeff at 480-729-8899. That's 480-729-8899.
More music 24 hours a day.
Are you having plumbing or septic problems? No worries. Call Cartwright's Queen Creek Plumbing and Septic Service. Been in the Valley since 1996. Family owned and operated. Proudly serving East Valley and surrounding areas. With a full range of services from drain cleaning, septic tank pumping, general maintenance and repairs, inspections for the sale of your home. They provide excellent and courteous service for all your plumbing and septic needs. We're not satisfied till you are satisfied. Licensed, bonded, and insured. Call today. Cartwright's Queen Creek Plumbing and Septic Service. Contact Denise at 480-987-8051. That's 480-987-8051. When you visit Hill Family Dentistry in Santan Valley, dentist Dr. Tim Hill provides each patient with personalized, gentle care that you deserve. Our entire team is dedicated to providing you and your family with services that will make you smile. With a full range of general, cosmetic, and specialty dentistry services that will keep you and your family smiling. Our commitment to our community is to provide outstanding oral health. Hill Family Dentistry is located on 36359 Gansell Road in Santan Valley, diagonally across from Banner Ironwood Hospital. Evening and weekend appointments available. We accept most insurances and have in-office policies available for non-insured. Contact us today at 480-588-8127. Hill Family Dentistry.
As a small business owner, you need to make every dollar count. Phone services are the first indication of quality your customers see in your business.
Get all the latest features at a great monthly cost that can save you money and project your business as a professional entity.
Call Zentris Communications at 1-877-ZENTRIS. That's 1-877-936-8727.
That's 1-877-936-8727. Got pain? Call Dr. Wayne. Chiropractic care may be your answer. Queen Creek Back Care. Located in Queen Creek on 20231 East Ocotillo Road on the backside of True Value Hardware Store. Safe, effective treatment with chiropractic and same-day appointments to speed your healing. With more than a decade of experience and hundreds of satisfied patients, Dr. Wayne Christensen will provide you the pain relief you've been searching for. Dr. Wayne is fully qualified to treat the entire family, even children. Call for an appointment today. 480-677-3900. That's 480-677-3900.
Welcome back. You are with Certified Financial Planner Nancy Fleming and Certified Public Accountant Kevin Boudreau and Joe, and we are talking about ways we can keep our money in our pockets, considering we have all of these taxes going forward, and there's not a clear consensus on exactly what the new tax bill will be doing. So I wanted to ask you, as we were discussing this Medicare surcharge, right? Mm-hmm. Is it a Medicare do they name it Medicare surcharge tax, or just
it's a
it
tax.
doesn't matter. Okay. Regardless of what we call it.
We'll call it the Medicare tax. Just
okay,
to make
the
it simple.
Medicare tax, which is different than the Medicare premium coming out of the Social Security.
Different than the Medicare premium that the retirees are paying, but also different than those of us that either pay self-employment tax, or if we have an employer and we're getting a W-2 at the end of the year or each paycheck, we have, I earned my $100, but yet there's 4.2% going to Social Security and 1.5% already going to Medicare. And then the employer is kicking in another 1.45 to Medicare and 6.2 to Social Security. This is all on top of that.
Oh, dandy. Now, is all this really going to Medicare? I mean, again, we've got the retirees paying their premium. We have the employer paying the Medicare premium. We have the employee paying the Medicare premium. Now we have the Medicare tax on top of all of this. Is it really all going to Medicare? And if it is, why are the doctors suffering?
Well, okay, so
that's like three questions. Sorry.
So a politician wrote the bill, right? And you're going to ask me, is it really going to happen the way it's presented?
I'm just trying to understand how do we protect ourselves and keep our money in our pockets, and apparently we're going to have to pay our doctors ourselves if the law lets us even do that.
Yeah.
So I guess my question is this new surtax going to actually go to Medicare?
My understanding is yes, it is going to Medicare. However, each year Congress comes up and appropriates money, and so therefore is it really going to stay in that bucket? I'm skeptical with respect to that because we've got a Social Security system that we know is projecting to run out of money. Mm-hmm. Might it move over there?
Well, it might go to the IRS. Now, remember, we just had, $500 million moved from the Medicare fund over to the IRS, so we were joking about how the next wealth check, we ought to go knock on the door of the IRS. I mean, so yes, that makes sense, though, that we don't know. It initially goes there, but the appropriation seems to mix the pot up a little bit.
Each year they come up with a new bucket.
We got Mark J. out of Phoenix. Says he received a letter from the IRS. He's accumulated a lot of cash in his
congratulations.
His past many years of working off the books at the swap meet. He would like to buy a house or a car, a boat, or something major. Will he get flagged? What can he do? Can he see you and you can help him out? Very worried about spending that money.
I love these problems.
Aren't these great? The great thing is he's earned the money at the swap meet, which you said was okay.
He said it's always been a cash-only business. He hasn't filed in over 10 years.
Right, but is the cash sitting in a bank account where it's documented or cash under his bed?
Home.
It's at home. Okay, what do we do?
So let me fast forward to today, and I'm going to ignore the past for a second because I know I can get away with a legal answer with this one. You're going to take, let's say we go and invest it in a home. There are plenty of people out there that pay cash for homes. The fact that you have that money, you eventually deposit it in the bank if it's literally at home, and then you put the money down or you take out a loan, you pay off the loan a little bit faster. Nothing wrong with that. And in fact, I think that's prudent spending.
But doesn't he need to file something if he puts that in the bank?
I don't know if is it the ownership of cash that triggers it, or isn't it making money on the ownership of cash? Because a lot of people keep cash in their house.
Okay, the bank is required to just file an informational return if you have a single transaction of currency, cash, that's $10,000 or greater. So hypothetically, I walk into the bank on Monday and put $9,000 into a brand new bank account. I can walk in Tuesday and put in $9,000 into the bank account. Wednesday, Thursday, Friday, etc.
Oh, no kidding.
And that does not trigger any requirements from the bank. Now, you may really get some nice friends on the teller line, as you're bringing this money into the bank.
You don't think the bankers would want to be heroes and fill that out, huh?
No, they don't want extra paperwork.
Gotcha.
Because remember, they're sitting just like us. They don't like their various auditors and the feds to come in and take a look at their records either. So as long as a transaction is not into that fifth digit, if you will, over $10,000, there's no reporting requirements with respect to that. So he could move it into an account, be able to write a check, take a wire, and make the investment from there. Now, as I said, I ignored the prior with respect to should there have been some tax returns. There's maybe a potential, with respect to that, because if you've got a business, then you do have that incumbent responsibility to file the tax return for your business.
Even if it's a cash business, because your services, right? Yeah, you're supposed to file returns.
Exactly. And you're supposed to be reporting it regardless of how you got the cash. And that kind of reminds me of a story. I've had a couple clients over time where they'll come up and, oh, Kevin, will you do the tax return? Or can I do your tax? Or will you do my tax returns? Like, sure, I'll do it. And it's like, oh, here, how about if I pay you in cash? Because then that way you won't have to worry about reporting it. And I'm like, hello? I'm sending my work product to the IRS.
Right.
They know that I did work for you, so I've got to show something. And not that I've ever, been looked at that granular detail.
That was Mark that called back and said, thank you very much.
Oh.
I'm taking the answer and running. Okay, beautiful.
Right, yes. Yeah, well, like I said, especially if there's people, I know, like, people who don't trust banks, and people don't anymore. We went for a period of time where they did, but I'm sure many of us know, and especially when my grandmother died, when my grandmother and grandfather died, especially with my grandfather, his room was stuffed with cash. He never put money in the bank. They found it in the mattress. They found it in the walls. They found it under the drawers. Oh, yeah, Depression era where the banks lost all their money. There's no way they were putting money in the bank. And so that's why I'm saying there are people who maybe they got all their cash from a yard sale. If you do that where you're not required to report it, then that's why I'm saying I don't think owning cash is the problem.
And a swap meet business is certainly probably up at the top of that list.
Absolutely. Yep, absolutely.
Yeah, because you have expenses and it depends on, only the person knows whether or not they made a profit.
What about say a waitress or a karaoke host or a DJ that gets tips? That the same thing?
There are special rules for the hospitality industry with respect to that, but let's take the DJ, because that's probably really the one
that interests Joe right now. We're slipping your money under the table.
That had nothing to do with me.
Nothing, huh?
Those eyebrows
that was
going up.
Somebody else.
Somebody I once knew.
So we have a DJ, just Joe, for example.
One of Joe's friends.
Yeah. Again, by the black and white letter of the law, you're supposed to be reporting all of your income. And especially if you are providing services through being a waitress, through being a disc jockey, whatever, in these personal service industries, you are supposed to report that.
Or a massage therapist. There's a ton of them.
Yeah, any place where you give tips, or like you get me. I get
groomers.
My nails done.
Yeah,
if
right.
you do a good job, you give them a tip for doing your nails well or your hair. Yeah, dog groomers, another good one.
You're supposed to report that, huh?
Black and white, you're supposed to report that.
Gotcha. I've never gotten a tip, so I wouldn't know, but...
Don't bet on three-legged horses.
Gotcha.
There's your first tip.
That's perfect.
And you don't have to report that one. So,
oh, nice.
So you're still set.
Well, very good. What are some other things? Like in this area, we have a lot of small employers, and by government standards, small employers are people with 50 or less employees. There's a lot of us out there that maybe have less than 10 or less than 6 employees. How is a lot of the new rules and regulations and taxes affecting the truly small employer?
Yeah, starting out, the small employer, let's say 6 and less, is not going to be directly affected.
Are they going to be forced to provide health care, for example, like the big companies who are concerned about that?
Right now, no, not at the employer level. What's happening, though, is because of the Supreme Court's decision, each individual person will have that responsibility. So it's sitting at the individual level as opposed to the employer level.
So if someone's working for a company that only has 3, 4, 5, 6, like I said, our small ones, they are not going to come to that employer and force that employer to buy insurance for the 3 or 4 employees. The burden is going to be on the employee to buy their own insurance.
That is correct.
Now,
yes.
What if it happens if the employer, it's a good employee, and the employer decides that they want to go ahead and pay that premium for the employee? Can they do that and have that?
Oh, absolutely.
That can still happen.
I've got a client that moved into that space. That they were in operation for about 5 years. They were finding that they weren't able to retain the better employees because they did not they started out just by offering a health plan and dental plan, and then they started contributing more and more and more, towards the cost of the employee, because in order to get the group rates, you need to have so many people, and you have to have, in the insurance industry, it's called a census. So you have to have so many people that are healthy to be in the proper pool.
But the small groups are expensive. So
exactly.
So if you're looking, my thought was if from the employer, the employee or employer, if you're looking to compensate the employee more, a way to compensate the employee more is then to go ahead and pay that premium for the employee, and it's not a group plan, it's still individual, but that's a way for compensation to come to the employee. Now, what's the tax ramifications to the employer and the employee if that happens?
Great question. The employer is going to benefit from that because they've got a legitimate tax deduction.
So they get to deduct it. So in other words, it's a way for the employer to give the employee more without paying more FICA taxes.
Exactly.
Okay.
Exactly. Then you've also got the W-2s, and this caused an uproar starting a couple years ago, where W-2s will be disclosing the dollar benefit of those healthcare premiums that the employer paid for the employee. Now, people jump to the wrong conclusion very quickly that I'm going to get taxed on this. Like, no. You're not going to get taxed on it. It's an informational box only.
Okay, because they do, because I get calls every year from people who especially make distributions from annuities, and there is the distribution amount, and then there's the taxable amount. And so that's on the W-2. There's the benefit amount, and then there's the taxable amount. So this is a win, one of those things that's a win-win. So for the employer, it pays no FICA, the employee gets an additional benefit, and nobody's paying tax on it.
Right, and let's say
that's nice. That's a nice benefit.
Yeah, and if you're a sole proprietor, or if you're a partnership, or even if you're an S corporation, if you can drive down your self-employment tax because you're providing these benefits to your employees, then you're going to be saving, this year 13.3% of self-employment tax plus whatever your income tax is. So it's not going to cost you the full 100%, but it's still cash. You've got to pay 100% of the cash. And so if the premium is, $1,000 a month for the family and you're doing it for your 3 employees, you've still got to have the $3,000.
So it's kind of a nice thing, again, whether the employer or the employee is thinking this about the employee should receive more. It's a nice way for the employee, if they want to approach their boss, to say, gee, maybe you could pick up some of this, and the employer's thinking, okay, I don't have to now calculate the FICA, which is always on the top of everybody's mind.
Right, and I'm going to clarify one thing before I think we hop over to a question here. Now, you can pay for it direct and outright. I can't, if you're my employee, I can't say, I'll give you an allowance of $300, of $500. That allowance, because it's something called non-accountable, is taxable.
You don't know what you don't know what they really do with the money. So in other words, the employer has to actually directly pay the medical, kind of like the medical deduction. If I'm going to help my daughter with a medical bill, I cannot give her the money and deduct. I have to actually pay the doctor.
Right.
Okay, and it's the same thing. Yep. All right, our question.
Julie from Mesa said her and her cousin are having a great time watching the show.
Oh, good.
They would like to know if you have a website, and Nancy, your website, and also if Kevin, if you do bookkeeping on top of CPA stuff. She just received a letter that her CPA has been arrested. Looks like she's going to be looking for a new one.
Maybe doing some of those tricky things you didn't. Yeah, Kevin, give your number and give your all your contact information first. And do you do bookkeeping?
Okay. Boudreau Consulting. Our address is 1237 South Val Vista Drive in Mesa. That's on the southeast corner of Southern and Val Vista. Phone number is 480-776-3358. Yes, we do have a, let's see, in parentheses, put the word week website. I'm a numbers jockey. I'm not an IT person. So we do have a website, www.boudreau, that's BOUDREAU, consulting.com. And it's got a few little helpful hints. In fact, it's probably a little bit closer to some of Nancy's stuff, some of the tools and stuff that I have on there, because it's more from the planning perspective. But, yeah, give us a call. I'll be happy to.
And I don't know if it was important. She said she was on the QuickBook platform.
Okay.
So
QuickBooks is a popular, and it's a good software. especially for new clients starting out. I happen to be what's called a QuickBooks Pro Advisor, and so yes, we do. But that sound important?
Oh, a QuickBooks Pro Advisor. You're all set, Julie,
yes,
and your
Julie.
cousin.
It really sounds good, though, Kevin.
Yeah, right on.
A CPA and QuickBooks Pro Advisor. We do bookkeeping for other small businesses. We do have a number of different industries that we cover. Where are they going? Oh, I was going to say companies that start out. QuickBooks is not the be-all and end-all. In fact, I've got some clients that are actually more successful using Excel spreadsheets depending on the volume of transactions that they have, because
wow.
You have to remember, QuickBooks is written for accountants. So folks that think like accountants love QuickBooks because they understand how it works. Just like if some of the Adobe and Print Shop and all that stuff, I can't use that because I don't think that way. I'm terrible at that stuff, but...
That makes sense.
Well, why don't you give your contact information?
I will. And my website is FlemingFinancialServices.com.
With one M.
One M on Fleming. And my phone number is 480-632-8770.
And it's 7:15 already, believe it or not.
7:50? We just had a great time, Kevin. I really appreciate you coming with such wonderful information about how we can keep our money in our pockets. We don't really understand what motivates the government to keep wanting to pull our money away from us. I don't know that we ever will.
Well, they're just like us. They want money in their pockets. That's an inherent clash.
Apparently so. All right.
And the great thing is, you're going to see lots of new changes with Nancy's web presence and Facebook presence within the next few days here. So check it out.
Yes,
yeah, absolutely.
I'm really excited about that. Thank you.
Money and motivation.
Thank you for joining us. We will have some really fun and interesting guests coming up this next month in October. So be sure to stay in touch, and you have a great evening.
If your carpets are dirty, grouting out so pretty, couches and love seat look like the kitty, give Riggs Services Carpet, Tile, and Stone Cleaning a call. Riggs Services Carpet, Tile, and Stone Cleaning is a local family-owned company who truly care about the service you receive. They guarantee 100% satisfaction. You deserve it. Contact Riggs Services Carpet, Tile, and Stone Cleaning at 602-492-6354.
This is Mike McCord. I would like to serve as your Pinal County Supervisor, District Number 2. With zero opportunities for error, I understand the needs of one of the fastest growing communities in the United States. This is where my experience and education come into play. I hold a master's degree in business administration and have worked as an operations manager for a paramedic service, as